What happened in the stock market today, you might wonder? Well, today we're focused on the performance of the S&P 500. This influential index is making a comeback, edging back towards its record levels. The market is breathing a sigh of relief as stocks wrap up a winning week. What's causing this uptick? What factors are driving the S&P 500's resurgence? It's a story worth telling, and we're here to tell it. Stay tuned as we delve into the factors that led to this performance. Several factors contributed to the S&P 500's performance. Let's take a closer look at these elements, as they offer a comprehensive understanding of the forces at play in the stock market. Firstly, we have economic indicators. These are statistical metrics that help us gauge the overall health of the economy. Think of them as the economy's pulse check. They include things like GDP growth, unemployment rates, and inflation statistics. When these indicators show positive trends, it typically bodes well for the stock market, including indices like the S&P 500. Next up, we have investor sentiment. Now this one's a bit more abstract, but no less crucial. It's all about how investors are feeling about the current and future state of the market. Are they bullish, filled with optimism and expecting prices to rise? Or are they bearish, bracing for a downturn? These sentiments can significantly sway the market's direction, including the performance of the S&P 500. And then we have corporate earnings. This factor is pretty straightforward. If companies are posting strong earnings, it suggests they're doing well, which can boost their stock prices. On the flip side, if earnings are weak, it could signal trouble, potentially leading to stock price declines. The aggregate of these earnings across many companies can impact indices like the S&P 500. But remember, these factors don't exist in a vacuum. They interact with each other in complex ways. For instance, positive economic indicators can bolster investor sentiment, which in turn can lead to increased stock buying and higher corporate earnings. Conversely, if economic indicators are negative, it can dampen investor sentiment, potentially leading to selling pressure and weaker corporate earnings. In essence, the stock market is a complex ecosystem with numerous factors influencing its direction. By understanding these elements, economic indicators, investor sentiment, and corporate earnings, we can gain a better grasp of why the S&P 500 or any other index for that matter moves the way it does. Understanding these factors provides valuable insights into the dynamics of the stock market. Economic indicators play a crucial role in the performance of the stock market. Now, let's dive into why that's the case. When we talk about economic indicators, we're referring to a set of data points that provide information about the overall health of the economy. This includes things like gross domestic product or GDP, unemployment rates, inflation rates, and interest rates. Each of these indicators can have a significant impact on the stock market and in turn, on the S&P 500. Let's start with GDP, which stands for Gross Domestic Product. This is the total value of goods and services produced by a country in a given period. It's a measure of economic activity, and it's a key indicator of economic health. If GDP is growing, that's a good sign. It means businesses are producing, people are working, consumers are spending, and the economy is humming along. This typically bodes well for the stock market and can lead to a rise in the S&P 500. Next up, we have the unemployment rate. This is the percentage of the workforce that is jobless and actively seeking employment. High unemployment can be a sign of economic trouble. If people aren't working, they're not earning money, they're not spending money, and that can hurt businesses. This in turn can put downward pressure on stock prices. Then, there's inflation, which is the rate at which the general level of prices for goods and services is rising. Moderate inflation is generally seen as a sign of a healthy economy. However, high inflation can erode purchasing power and can lead to higher interest rates. And finally, we have interest rates. These are set by the Federal Reserve and they influence borrowing costs. When interest rates are low, it's cheaper for businesses to borrow and invest in growth, which can boost stock prices. But when interest rates rise, borrowing becomes more expensive, which can slow economic growth and negatively affect the stock market. These economic indicators give us a glimpse into the health of the economy and how it impacts the stock market. By keeping an eye on these indicators, investors can make more informed decisions about where to put their money. Investor sentiment is another critical factor in the stock market. It's a fascinating element, a collective measure of the mood or attitude investors have towards the market at any given time. This sentiment is shaped by a myriad of factors, including news, political events, and market trends, and it plays a pivotal role in the performance of the S&P 500. Let's take a closer look at how this works. Imagine news breaks out about a significant political event, say, an unexpected election result or a sudden change in government policies. This information spreads, reaching the ears and eyes of investors around the globe. These investors in turn process this information and react. If the news is perceived as positive, it can boost investor confidence, leading to increased buying activity and potentially driving up stock prices. On the contrary, if the news is seen as negative, it can instill fear or uncertainty, prompting investors to sell off their stocks and potentially driving prices down. But it's not just news and political events that shape investor sentiment. Market trends also play a crucial role. For instance, if the S&P 500 has been on a consistent upward trend, this can create a sense of optimism among investors. They may believe that this trend will continue, leading them to buy more stocks and further propelling the upward movement of the market. Conversely, a downward trend can breed pessimism, leading investors to sell their stocks in fear of further losses, which can exacerbate the downward movement. Investor sentiment is a powerful force capable of moving markets. It's a complex and ever-changing phenomenon, influenced by a wide array of factors, and it's something that every investor should keep a close eye on. After all, understanding the mood of the market can help investors make informed decisions, potentially leading to better investment outcomes. Investor sentiment can often make or break the performance of stocks. So the next time you're evaluating the stock market, remember to consider not just the hard numbers, but also the softer, more subjective element of investor sentiment. Corporate earnings significantly influence stock market performance. One of the most influential factors in stock market performance is the earnings of corporations. These earnings, and the projections of future earnings, can drive the stock market in significant ways. As investors, it's essential to understand this relationship and how it can impact our investment decisions. Let's consider the S&P 500, a stock market index that measures the stock performance of 500 large companies listed on stock exchanges in the United States. The S&P 500 is often considered the most accurate representation of the U.S. stock market and a bellwether for the U.S. economy. Now, when a company within the S&P 500 reports strong earnings, it can cause the value of that company's stock to rise. This increase can then drive up the overall value of the S&P 500. Conversely, if a company reports weak earnings, it can cause the value of that company's stock to fall, which can then lower the overall value of the S&P 500. Let's look at some examples. Consider a technology giant like Apple, or a multinational conglomerate like Procter & Gamble. When these companies report strong earnings, it can lead to an increase in their stock value. This rise can then drive up the value of the S&P 500, given their significant contribution to the index. On the other hand, if a major energy company like ExxonMobil or a healthcare behemoth like Johnson & Johnson reports disappointing earnings, it can lead to a decrease in their stock value. This drop can then pull down the value of the S&P 500, given their substantial weight in the index. Thus, a company's earnings and the projections of its future earnings can significantly influence the stock market's direction. As investors, understanding this relationship can help us make informed decisions and potentially capitalize on these market movements. Corporate earnings are a direct reflection of a company's performance and can significantly impact the stock market. In summary, the S&P 500's performance is influenced by a combination of factors. The dance of the stock market is a complex interplay, with each player adding its own unique rhythm. Firstly, we explored the various factors that have a direct impact on the S&P 500. These include geopolitical events, policy changes, and market sentiment, all of which can cause ripples of change in the stock market's performance. It's a delicate balance, and a sudden shift in any one of these factors can lead to significant fluctuations. Next, we delved into the realm of economic indicators. Unemployment rates, inflation, and gross domestic product all play a crucial role in shaping the market's trajectory. These indicators provide a snapshot of the economy's health, and a positive or negative trend can significantly influence investor sentiment. Speaking of sentiment, we also discussed the impact of investor confidence on the S&P 500. Fear and greed often drive the market, and understanding these emotions can give investors a competitive edge. When optimism reigns, the market tends to rise. When pessimism takes over, it often falls. Lastly, we touched on the importance of corporate earnings. These quarterly reports provide a window into a company's financial health, and strong earnings typically boost investor confidence and push the market higher. By understanding these factors, you can make more informed decisions about your investments and navigate the complex world of the stock market with greater confidence.